value can be a funny thing. It can be in the eye of the beholder, change slowly, or even change rapidly in the blink of an eye. Unlike a scientific formula, a formal appraisal is nothing more than an estimate of value created by a licensed appraiser that tries to factor in current market conditions using all pertinent information. While the process can seem mysterious, it's just one qualified person's opinion on a particular day based on the information and evidence they have available at the time. The standards which real estate appraisers must follow would normally be dictated by a nonprofit organization founded in 1987 called the Appraisal Foundation. Each state would license and certify appraisers individually, but they generally follow the recommendations for training and best practices provided by the different boards of the Appraisal Foundation. The specific guidelines related to developing and reporting an appraisal come from the Appraisal Standards Board and are commonly referred to as Uniform Standards of Professional Appraisal Practice. These same rules do not apply to real estate agents and brokers. When listing a home for sale, it's common for the agent to complete a competitive market analysis, CMA. While they might use some of the same information a licensed appraiser would, like the sales prices of other homes in the same neighborhood, the CMA would not contain the detail or be nearly as comprehensive as an appraisal. In addition, a CMA is not sufficient proof of value for most lenders to make a loan. However, some lenders do rely on brokers when an owner has fallen behind in making loan payments. In an effort to assess their financial risk, the lender may hire a local agent or broker to perform what's known as a broker's price opinion, BPO. Sellers would not typically be cooperative, so this might entail a quick trip to the home where an outside picture is taken, a la paparazzi style, and also includes a brief analysis sent to the lender of both the outside condition of the property and current market conditions. This helps the lender estimate what money could be recouped if the property ultimately lands in a foreclosure proceeding. Everything in real estate is negotiable, but the prices paid for BPOs would generally be 1/4 to 1/3 of what an appraisal would cost. How would an appraiser estimate value? There are two types of information that need to be gathered. General data, which is just general information about the neighborhood or the city, such as what's happening in the area in terms of the overall market and job stability. Specific information would encompass the details about the property being valued, such as square footage, bedrooms, baths, and amenities, in addition to facts about similar properties that had recently been sold. Gathering data is actually the third major step in the appraisal process behind identifying, defining the situation, and listing the data needed. The fourth step is to determine the highest and best use of the property. What legal use would generate the highest return or profit, but is also permissible given current zoning regulations. For a single-family home in a subdivision, the use is almost certain to be as a dwelling. But what if you had an older home on South Main Street that now has lots of traffic after a widening of the road? Is it possibly zoned for business use so that an attorney or insurance agent might relocate their office? The highest and best use can also change over time. What if a new office building is suddenly being built next door? Does that change the best use for the property? These factors will be taken under advisement before a determination of value can be provided. The fifth step in the appraisal process is to estimate the land value separate from any buildings, as it will remain regardless of what happens to any structures. The sixth and most important part of an appraisal is to estimate value using the various approaches to value. There are three distinct ways to value property, with each approach particularly suited for specific types of property. The sales comparison approach, the cost approach, and the income approach to value can all be used by the appraiser whenever appropriate based on the property in question. When would you use the sales comparison approach to determine value? This method is used every day when valuing residential property. The core principle is that a property, let's say your single-family home, the subject property, is worth approximately the same amount as what other similar homes, also known as comparables, have sold for recently in the area. For example, the home next door to you recently sold for $200,000. Assuming it wasn't a foreclosure or duress sale and your home is virtually identical, then your home is worth around $200,000. Of course, using only one reference point could skew the data. Therefore, a normal appraisal would reference at least 3 sold properties while numerically accounting for any differences between the homes in question. The results would be averaged or reconciled to provide the final estimate of value. Let's look at a quick example of how numbers would be adjusted. The home next to you is identical to yours with the exception that it has a 3-car garage and your home only has a 2-car garage. In this example, your neighbor's home is slightly better, i.e., worth more money because it has a larger garage. If your neighbor's home sold for $200,000, your home would sell for slightly less. So, if the appraiser determines that the additional present value of an extra 1-car garage in your area is $10,000, your home might be appraised at $190,000. That is, $200,000 minus $10,000. One easy way to remember this is CBS. If the comparable is better, then you subtract because we're trying to figure out what the subject property is worth. In essence, we know that the original sales price needs to be adjusted to account for any and all physical differences between the homes. It works just the opposite if your home is better than the comparables. In that case, you would add an amount on top of what your neighbor's home sold for to arrive at an estimate of value for your home. Where are these comparables found? How do appraisers choose which ones to use? They have to sift through all of the sold information and organize the properties, choosing the ones that are most similar and those that have sold more recently. Most appraisers are members of the same multiple listing services that real estate agents belong to, so they can access currently listed and sold information online. They can also reference any other public information available to them at the recorder's office or courthouse. Using the two together would give a more accurate account of all property that was listed and sold, including for sale by owners. Remember, the more up-to-date and comprehensive the information, the more accurate the appraisal is likely to be. The second type of valuation method, the cost approach, is better suited to unique properties like schools or churches. Properties such as these are seldom rented or rarely sold, so the total cost to reconstruct becomes the most important method when appraising current value. The appraiser would start by separating the land and the structures so a unique value could be placed on the land. They would then determine what it would cost to rebuild the structure using today's prices. While different methods exist, the easiest and most commonly used way is the square footage method, where averages for the community are multiplied by the total square footage. For our example, we'll keep it simple, but garage space or basement square footage would be treated uniquely, as each would have a different cost to build. Let's say a building is 2,000 square feet and the average price per square foot to build it today is estimated at $100 per square foot. Don't get hung up on the price per foot because this changes over time and depends on costs in your community. But, using our numbers, the cost to replace the building would be 2,000 square feet times $100, or $200,000. Unless the building is brand new, an adjustment would need to be made for depreciation of certain items such as the roof, the heating and air unit, the carpet, etc. In these cases, the appraiser would deduct the total accumulated depreciation. There are different ways of determining the existing depreciation which go beyond the scope of this explanation, but for argument's sake, let's assume a depreciation rate of 10% for this 5-year-old building. The current value of the structure, as it sits today, would be $200,000 minus 10%, or $20,000, which results in a building valued at $180,000. At this point, the appraiser would add back in the value of the land, which would be included in any sale. Let's say it's $50,000. So the current value of the building and land would be $180,000 plus $50,000, which is $230,000. Separating out the land and adding it back in can be confusing, but there's a good reason why it's done. Land is not depreciated because it will always be there, assuming no mudslides, whereas any man-made structure has an estimated lifespan. The economic life is the time period that the appraiser determines the property will continue to be useful for its intended purpose, which in turn helps them determine current depreciation. If depreciation seems subjective to you, then you'll probably like the final and very straightforward income method of estimating value. The income approach to value is commonly relied on heavily when trying to determine a value for rental properties. Since investors are all about making a return on their investment, they prefer verifiable documentation they can use to determine a reasonable value. This is accomplished using a formula commonly referred to as ERV. The yearly net income of a property divided by the desired rate of return would result in a suggested value. If a building's rent for the entire year is $24,000, $2,000 a month, and the investor wants a 10% rate of return, sometimes referred to as a capitalization rate, then the building has a value to that particular investor of $240,000, $24,000 divided by 10%. There is an inverse relationship to value and the desired rate of return, so the greater the desired return, the less the investor could pay for the building. If they wanted a 20% rate of return, the building would only have a value to them of $120,000. That's $24,000 because the income remains constant, divided by 20%. In these calculations, it's important to remember that income is net income, not gross income. This method can require some number crunching because there could be expenses and potential vacancies or credit losses, tenants not paying their rent, which would reduce the actual net income an owner would receive. If this math is making your head spin, here's a substitute method that's sure to make you smile. It's a shortcut method that might be used for properties that would not necessarily be purchased exclusively for income, such as a single-family home in an owner-occupied area. It factors in rental income, but not expenses. It's called the gross rent multiplier, or GRM, and it's nothing more than a relationship between value and rental income. The appraiser would determine the possible monthly rent and multiply it by the GRM for the area. This would result in the projected value. If the GRM is 100 and the property would rent for $2,000 a month, according to this approach, its approximate value is $200,000. $2,000 times 100. You may be asking yourself, where does the GRM come from? That's an excellent question. It is generated by what other properties have sold for in relation to what they rent for. So, if the home down the street sold for $250,000 and rents for $2,500 a month, assuming this was consistent with other properties, the GRM for the area would be 100. $250,000 divided by $2,500. In other words, the value of homes in this area is 100 times the monthly rent. Many old-time investors have used this method for years. They just don't know what it's called. They simply multiply the rent they projected by 100 to determine the value. Therefore, a home that could rent for $500 a month is worth $50,000. A home that could rent for $600 is worth $60,000. Each of the appraisal methods has its own pluses and minuses, depending on the situation and type of property being appraised. While they each are best suited to a specific type of property, in reality, the appraiser will use at least two of the three approaches on every property to confirm the value as best they can. If it's a single-family home, the appraiser will pay more attention to comparables. They may also calculate the value via the income approach and/or the cost approach to confirm what they discovered when viewing the comparable sales information. The term reconciliation is used to describe taking all of the methods and numbers used to ultimately arrive at the final number that serves as an estimate of value. It seems like a lot of work, and everyone is still going to argue over it regardless of what the appraiser says.
What's it worth? A common phrase auctioneers hear before the sale, but to estimate value, we need to understand some basic underlying principles. First, a property needs to have some fundamental characteristics, which are remembered by the acronym DUST, DUST: demand, utility, scarcity, and transferability. Is there a demand for the property? If not, it has little to no value. Is it useful in its current condition? Is there an infinite or limited supply? If every home in a neighborhood or town is for sale, what value could an individual property have? Finally, can it be transferred to new ownership? If a deed restricts ownership, it will most likely have a negative effect on value. It's important to understand that when you hear the term value, there are different types for different situations. There's market value, which is what a property should bring, but there's also assessed value, which is what the tax assessor has listed for value on their tax rolls. In many cases, assessed value doesn't keep pace, up or down, with market trends, as most assessors don't revalue property every single year. Perhaps the most important concept to understand is that value does not always equate to cost or the price you pay. The best illustration of this is to watch any number of the shows on television that value antiques, or follow those on their quest for unique items and their efforts to get a deal. Because real estate is not typically a once-in-a-lifetime find, the values tend to be more stable and predictable. But there are some basic overarching principles in economics that can explain various aspects of value. Perhaps the easiest principle to explain is anticipation. This theory is rooted in basic human behavior and really separates us as a species. If you believe, anticipate, something will happen, you will act or plan on that assumption. So if you and others hear rumors that a major retailer is looking to buy land near you, the value of the commercial land in the area will jump up overnight based on the expectation of future events. If the rumors turn out not to be true, then the speculation will go away and prices for land will drop significantly. The old saying goes, "Don't believe everything you hear," because if you purchase on a rumor, you may have to sell back down at reality. Another principle of value is conformity, which implies that maximum value is achieved when surrounding homes are in harmony. Not identical, mind you, but in harmony. It's easiest to describe the negative effects when this doesn't happen. You probably know one house that stands out in a neighborhood, whether it's the so-called artwork in the front yard, the paint color, or the year-round Christmas lights. If one house is not in harmony with everything else around it, the value of the surrounding neighborhood can be affected. What if the house is much smaller or larger than the homes around it? How does that affect value? There are two principles that cover these situations: progression and regression. Progression describes a small home surrounded by larger homes. The value of the larger homes helps pull up the value of the smaller one because it's surrounded by fancier and more expensive homes. The opposite is also true. If a larger home is surrounded by mostly smaller homes, then regression occurs. This would be responsible for a drop in value for the larger home because most people capable of paying more money than the neighborhood average would want to live in a better neighborhood. This brings us to the principles of contribution and diminishing returns. If you add an improvement to a property, it needs to add more than the improvement costs to increase your return on investment. A $20,000 kitchen remodel that only adds $10,000 in total value to what the property would sell for causes an actual loss of $10,000. You spent $20,000 and it only contributed $10,000 to the value. There is no rule in real estate that says if you spend money improving a property, you get that money back. As a general rule, you should really think twice before improving property beyond the price of what the average home in a neighborhood sells for, because several principles of value will be working against you. At some point, the property is worth its absolute maximum for the neighborhood, and additional improvements will not increase its overall value, which causes diminishing returns. A good example of this would be the Winchester Mystery House in San Jose. You may know this from television shows as the house with the stairs to nowhere, but Sarah Winchester, heiress of the Winchester rifle fortune, spent 38 years building her 160-room home, but most of the improvements didn't add any real value at all. What value does a staircase to nowhere have, or even tiny rooms with 13 windows to keep the spirits out? There is a situation when adding to something can increase value, and it's called the principle of plottage. Let's say you have a small commercial lot that's only 75 feet wide, which you've been unable to sell because there isn't enough space for parking or for a drive-through. If you combine your lot with the adjacent lot and offer these same companies a lot that's 150 feet wide, that will increase the possible uses and can increase the price dramatically. You could potentially get more than twice your original price by putting the two lots together. This is known as assemblage. We started this video by asking, what's it worth? Ultimately, it's worth what someone is willing to pay for it, but certain principles almost always apply in helping the buyer arrive at the amount they feel is a justified price. These may be real or they may be the result of guesswork, but everyone has reasons for buying and selling at a specific price, and sometimes you don't know until later whose vision was correct. The next time you watch someone on TV being told that the item they bought for $10 at a garage sale is an antique from the 16th century that's really worth tens of thousands of dollars, remember, there's a seller who at the time believed it was only worth $10.